Alright, gang, it's your boy Nature, aka Nature. Alright, so gang, we're back for another video. In our last video, we just ran over a summary of Japanese candlesticks 101. So in this video, we're going to be talking about moving averages, alright? Then after that, we're going to talk about Fibonacci or resistance, relative strength index, which stands for RSI. Alright, since we already ran over all the Japanese candlestick patterns, all the chart patterns, all the just all the basics, of what to expect and how to trade in Forex. We have to basically talk about the technical indicators that can help you, more. So these are technical indicators that can help you in the market, moving average, Fibonacci, and relative strength index, which stands for RSI. So these are our Forex technical indicators that we use in the market, and with the right information and applied the knowledge applied right, these technical indicators can be very useful. So alright, gang, let's start with what is a moving average. How to trade a moving average on the market. So alright, gang, it's your boy Nature, aka Nature, gang. Alright, so let's begin. So what are a moving average? So this is just the basis of what a moving average is. We kind of want you to know what a moving average is. These videos are going to be kind of short. We're going to do what is a moving average. We'll do all the videos, kind of short for you guys. So I won't just clutter you guys with video after with just long videos. So this is going to be we're just going to talk about what is a moving average, break down the definitions, and then in a few videos later you'll see how to trade a moving average in Forex market. So what is a moving average? So a moving average are one of the most common used technical indicators. A moving average is simple, a way to smooth out price for fluctuations to help you distinguish between typical market noise and the actual trend direction. So it helps you to distinguish between the typical market noise and the actual trend direction. Helps you to identify the actual trend direction. Moving average. So moving average, we mean that you are taking the average closing price of a current pair for the last X numbers of periods. On a chart, it will look like this. Alright, so this is a moving average of a closing period of the last 10 periods. So this is what a moving average is. Okay, it's the average closing period of a current pair for the last number of periods. So this is a 10 period moving average closing period is what it looks like. Alright, it's the blue line. If you didn't know, this is what a moving average looks like. Okay, it's the blue line, and we'll explain what this blue line means and how we can identify the trend. It don't matter the color, you can change the color, and red is usually like the color that people use. Blue is also a good color to use. So let's go back on the chart. This is what it looks like, a moving average on a closing price of the last 10 periods. As you can see, the moving average looks like a squiggly line overlaid on top of the price, representing the Japanese candlesticks. This type of technical indicator is called a chart overlay. The moving average is an overlay in the price chart. Okay, so like every technical indicator, a moving average indicator is used to help us forecast the future price. But why not just look at the price to see what's happening? The reason for using a moving average is, instead of just looking at price, is the fact that the trend do not move in straight lines. Okay, price doesn't move in straight lines. Price zigzags, and so a moving average helps smooths out the random price momentum or movement, and helps you see the underlying trend, the real direction of the trend. Okay, because price is constantly moving, fluctuating, zigzagging. By looking at the scope of the moving average, you can better determine the direction of the overall trend. So as we said, moving average smooth out price. Okay, price action through an X number of prices, or action through like an X number of X number of period the moving average smooths out price action for an X number of periods. So there are different types of moving averages. Each of them have their own level of smoothness. Okay, generally the smoothness of the moving average is slower to react to price action, and the choppier the moving average is, the quicker it is to react to price action. And we'll explain that. To make a moving average smoother, you should get a moving average close prices over a long time period. If you want it to be smoother and slower, then you're going to use a longer moving average time period. And if you want it to be short and choppier and quicker to react to the market and price movements, then you will want a shorter moving average. So how to properly change or lift your moving average. The length of a number of reporting periods of moving averages, including calculations, affect how the moving average is displayed on the price chart. The shorter the length, the fewer the data price points that are included in the moving average calculation, which means that the closer the moving average is, it stays to the current price, the actual price. This reduces its usefulness and may offer less insight, though, to the overall trend of current price itself. The longer its length, the more data points that are included in the moving average calculation, which means the less any single price can affect the overall average. Okay, if there's too many data points, price fluctuations may become too smooth. That you don't want to be detected as a kind that doesn't want to be detect any kind of trend. Either situation can make a difficult recognition if price direction may change in the near future. For this reason, it is important to select a period of moving averages that provides a level of price details appropriate for your trading time frame. Okay, so now we're probably thinking, come on, let's get to the good stuff. How can I use this to trade? In this session, we first need to explain the two major types of moving averages. Okay, they're simple and exponential. Okay, we'll also talk about how to calculate them and give the pros and cons of each. Just like in every lesson in babypips.com School of Philosophy, you need to know the basics first. After you get the lockdown on the different ways to use a moving average and how to incorporate them in your trading strategy, by the end of this lesson, you'll be as smooth as messy. Before we move on, just remember the moving average. Just remember that the moving average is a smooth price data to form a trend direction. The following trend direction is a technical indicator. So they do not predict price direction. Instead, they define the current direction with a lag. Because don't forget, it is a technical indicator. So all these indicators can tend to lag. That's why we use candlesticks. We know how to read candlesticks and all that too, just in case they lag. But technical indicators are very good to use, especially moving average. Are you ready? If you are ready, okay, let's get ready. So in our next lesson, we'll talk about moving averages and simple moving averages and explain that. So, all right, gang, this is just moving averages. This is the basics 101 about moving averages. All right, in our next example, we'll explain the different two types of moving averages and how to trade moving averages. Alright, so gang, it's your boy Nature, aka Nature, gang.